Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading week ending July 9th, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme, do you hear any thunder? Let's talk a little bit about the markets this past week. Let's talk a little bit about what's coming up. We'll take a look at the charts just to see how things are starting to shake out. So as always, we're going to start with the weekly sound bites, and we're going to start with the index performance for the U.S. markets. If we take a look at this, you can see that the Dow, S&P, and Nasdaq all barely finished in the green for the week with the strong finish we had on Friday. The Russell was in the red for 2 weeks in a row. Year to date, everybody's still very strong. The S&P took the lead, 16.33% year to date. It passed the Russell, which had been leading all year long. And then, of course, bringing up the rear, but still a very healthy 13.93% is the Dow. You can see the PE ratio, the forward PE ratio, which is what we're most concerned with because that deals with future price action and valuations, is priced at 22.72. And that number is still fairly high. The dividend yield for the S&P is at 1.33%. 10-year Treasury is at 1.356%. It fell a little bit this past week, but it's still about 2.6 basis points higher than the S&P. So that still funnels money into the S&P when you get a Treasury yield that's almost the same equivalent of a U.S. S&P dividend yield, right? So it's going to still channel money and direct it into the equity market. The current VIX was up about 7.36% for the week, coming in at 16.18. And then you can see sector performance this past week. The best was consumer discretionary, coming in at 1.46. The worst, energy, falling 3.25% with some of the mixed messages we're getting out of OPEC. Annual sector performance, though, energy still leading the way at 39.4%. Utilities bringing up the rear, but both in the green, utilities being in the green as well at 4.48%. So if we talk about the sector, we can see that really the major driver of sentiment this week appeared to be the steep decline in U.S. Treasury yields. But when it kept falling on Thursday, that was kind of speculation of why the markets did that hard down move Thursday before we had a strong rally on Friday. And, you know, a lot of speculation on why the markets moved down hard Thursday and then back up hard on Friday. We did see the Treasury yields move back up on Friday. But just keep in mind the 10-year Treasury, which is a benchmark worldwide risk-free investment. Generally, when you see the 10-year Treasury yields going lower, it just says that economic growth on a future dated basis for the U.S. markets is coming down a little bit. So there is some speculation on that. There's also a camp out there that says the reason why Treasury yields are coming down, meaning the bond market is going higher, is technical reasons for the Fed's buying and resulting in a short squeeze because everybody was short bonds. Okay, same thing with the U.S. dollar. Everybody's short the dollar, and the dollar moved up with a big short squeeze. So we could see some of that playing out as well. But it does tend to say that the economic growth on a future dated basis may be a little bit less than what people think. I would also agree with that. Okay. Now, if we take a look at some of the economic data that's kind of hitting for this past week, it generally indicated strong growth, but modestly on the downside. And we had the ISM gauge come in June a little bit lower than expected. We had economic optimism fall back to the lowest level since February. Weekly jobless claims also ticked a little bit higher. May job openings rose a bit less than expected. Okay, so all of that just kind of translated into a little bit of a softer market this week, which is why the equities were barely above flatline for the week. Okay, even given the strong close on Friday where we saw the S&P make new all-time highs. The other thing that I wanted to just kind of mention here was U.S. Treasuries. And we saw some crazy moves in Treasuries. The bond market has been rallying most of the week. And as I said, different camps as to why it's rallying. Some technical, short squeeze, that kind of thing. Others, saying that money is coming back into the debt market for fear of not as strong of a growth going forward. I think it's a combination of both. Okay. Um, 10-year Treasury actually sank to 1.25% in intraday trading Thursday before kind of partially recovering as we went through the end of the week. We did get minutes from the FOMC, but there was really no change in sentiment or market action when it was released on Wednesday. I mean, basically, there's Feds are saying the same thing. They're going to continue to support the market until they see substantial further progress, blah, 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 that kind of stuff. So kind of a wet blanket on the meeting minutes. Although I do believe this month we're going to see some big changes coming up. Okay, we got a very active week coming up. Members, we'll go through it Sunday evening on our weekly market watch. Going to be some really interesting things that can really set this market on fire. So it's a little bit about what I'm seeing in the Treasury market. Now, if we go over to Europe, we can see that the coronavirus infection rate continued to surge in the UK, even though Bulldog Johnson said they're just going to open everything up. Okay. Spain is experiencing their worst outbreak, partly due to the highly transmissible Delta variant. But folks, I mean, this stuff drives me nuts. There's going to be variants coming out on the COVID every single year. So, a lot of this to me is just garbage. All right. Think about it. Not one flu death in 2021 has been reported. Not one. All right. Last year, no flu deaths. How the hell can you not have a flu death? Well, because I would say 30 or 40% of all COVID deaths were probably more of a variant of the flu instead of COVID. But hospitals got paid to report COVID deaths. So there you go. And it suits. You got to look at the media outlets. It suits everybody to report what they want to report. And hospitals get paid for COVID deaths, so why not? Same thing over in Europe, although they're worse than us. They keep opening and shutting things down. We did see the ECB do a key change in their policy. They basically adopted a 2% inflation target over the medium term. Their previous policy was abandoning the previous objective of below but close to 2% as their inflation target. So in essence, they raised their inflation target. Okay, kind of what the U.S. did, but not quite as powerful. But anyway, that does put money back into the markets. It doesn't put money in the markets. It just says they're going to be a little bit more soft, a little bit more dovish in their reaction to inflation coming through the transom across Europe. The other thing that the ECB did, because they're kind of the woke ECB, they incorporated climate change in their framework of monetary policy operations. I mean, give me a break. Here in the US, the Feds only have two mandates: manage inflation and jobs, right? That's it, employment. Employment and inflation. And they're starting to try and expand outside their lanes as well, talking about environmental concerns, global warming, all that crap. I mean, come on, give me a break. But anyway, the ECB basically is expanding their operations to include a framework of monetary policy in areas like disclosure, risk assessment, corporate asset purchases, collateral policy, as it relates to carbon emissions. I can see that stuff washing up on the shore to our Fed. So just watch this stuff. I mean, it has nothing to do with the way the Fed or why the Federal Reserve was originally organized, but everything seems to be seeping into climate change. I mean, you can pretty much blame everything on climate change now. Had an argument with your wife, blame it on climate change. Oh, goodness, that's what's going on across Europe. And then, of course, if we look at the indexes and how everybody performed last week, again, um, everybody was pretty much in the red with the exception of the DAX. That's 2 weeks in a row, but just barely above zero. China barely above zero. If you look at the year-to-date performance, the CAC 40, the French index, is actually leading all global economies. Now, it's a small economy, and it doesn't take a big change to move it percentage-wise, but it's still leading the way, okay? China is just barely above zero. Same thing with the Nikkei. Nikkei had a bad week. Hang Seng had a bad week also this week. Okay. So that's kind of what's going on in Europe. And then, of course, if we do look at China, speaking of China and the Asian markets, the People's Bank of China unexpectedly, because the markets weren't expecting this. I guess that's what unexpectedly means. Announced that it's going to cut its reserve requirement ratio. They call it the R cubed, or RRR, another way to say it. The amount of cash that most banks have got to hold in reserve at the central bank. So the timing and size of that reduction, just days before China's reporting its second quarter GDP coming up this coming week, suggests that Beijing is a little bit worried about their flagging economic growth. I mean, look at their year-to-date performance. If you look on the screen here and see the year-to-date performance of all U.S. indexes and all European indexes, and then throw in the Nikkei, China, and Hang Seng, they're lagging dramatically. Well, Hang Seng's kind of tied in with China, but the Nikkei, they're lucky if they get over 4 or 5% every year. They've been in a deflationary funk for 2 decades. But Europe is very strong, but China should be at least 8 to 10%, and they're not. And one of the primary reasons is they've been cutting money, pulling money out of the economy for about 3 or 4 months now, and they've been punishing technology stocks, as you guys probably know. I've told our members to stay away from any Chinese stock right now as an ADR. Just stay away from them because there is a lot of potential things that can go wrong there. And we're seeing it with some of the technology shares in and across China. Members, I'll talk a little bit more detail about that this Sunday night for our weekly market watch. Now, if we come over and I just shift, and let's just go take a look at the key stocks and indexes here for you guys. Let me just move it over. And we're going to start off with the E-mini S&P 500 E-mini futures. We'll start with that one, of course. And then we'll end everything on just looking at some of the key areas here. You can see that this is a daily chart. You can see on Friday we made new all-time highs in the S&P 500 E-mini futures, 43.64. You can see the 50 moving average is now sitting around 42.20. That's going to be our first big test. I am still on record as saying we should expect a 7 to 12% pullback sometime before the next U.S. holiday here, which would be around first week of September, Labor Day weekend. So that would carry us through July and August. So I'm running out of runway here. I did this last year, and I kept calling for a pullback. And we finally got it in September of last year. So we'll see what happens this year. But I do believe 7 to 12% would be in order. And if we look at it, as always, I'm going to show you where that takes us to. Let's just take us down to 10%. 10% takes us right down to just north of the 200 EMA. A natural pullback would be the 200 EMA, which is about 11.32%. And the first fib node here would take us down just slightly under 12%. So 0.236 fib node or the 200 EMA is where I would look to see the markets hold up. But that's where I think we're going to go. Now, our test on whether it's a buy the dip moment or it's, sell the rally moment is going to be reaction around the 50 EMA. Now, I've gone through this in detail with our members on Sunday evening. No need to cover it here, but just essentially, we're going to know if the buy the dip crowd is going to get strong or they're going to get weak around the price action of the 50 EMA. Okay, so we're going to watch this really closely. If we look at the Dow Jones transports, which tends to lead the way, okay, so let me just pull the transports up. Had a very strong Friday. If you look at it, we're still well below the 50 EMA. The 50 EMA has started a downward trajectory. The 200 EMA has got an upward vector as well. So these two are going to meet. And we took out a previous low here, which is very bearish, right? The previous pivot low was at 254.65. We actually gapped down on Thursday and made a new pivot low right here, okay? And that new pivot low is sitting right around 251, 252 area right there. So, and if you look at the Elliott wave count, you'll notice we're on a 3-leg moving down. So any move up, we're in a sell the rally kind of mode. And Dow Jones Transports tends to lead the other markets. So if we flip over, and let me show you the Russell, which had an interesting Friday, but we're challenging and we're dancing around the 50 EMA. We just barely are holding on to the 50 EMA. We came down and we moved right back up just across the 50 EMA. But if you look at this rain dance here, our price is no different than where the Russell was on the 8th of February. The last all-time high was actually March 15th, and we haven't printed a new all-time high in the Russell since then. And the Russell is small cap and tends to be more of a risk on kind of trade. So the Russell tends to lead the other markets. And because we've been running sideways, you can see all this chop in the Russell. Very difficult to trade unless you're day trading or swing trading and you're taking profits on the upside of this range and you're going long on the downside of this range. Eventually, this range will be broken. I believe near term, the odds favor a downside break. We'll see how this market plays it out. If we look at the Dow, which also is kind of tied in with the Dow Jones transports, you can see the last high in the Dow was back in May, before we had that little bit of a pullback in May. And then you can see in early June, the Dow had a good steep drive down, right? And then we came back, regained the 50 EMA. We've been testing it a couple of times, but we haven't broken it. If we break that 50 EMA, this pivot point here is going to be a key for us, okay, in our trades. Now, with what I'm directing with all our members in our secret trader, we're still leaning long, guys, okay? Don't get me wrong. I'm not all short. I'm leaning long. I got a few hedges on, you know, and I'm showing our members how to hedge some of the things that we're running. But we are still leaning long for now. The minute the buy the dip crowd disappears and the sell the rally crowd shows up, then we're going to switch a little bit more and get more neutral to short and play a little bit more downside action. All right. So that's kind of what I'm looking at here. And then of course, if we look at Nasdaq was leading the way along with the E-minis, but Nasdaq did not make a new high on Friday like the S&P, but we had a recent high on Wednesday with Nasdaq. Okay. And if we look at our FANG index, which is Microsoft, Facebook, Apple, Netflix, Google, and Amazon, same thing. We made an all-time high in this index on Wednesday, and then it's pulled back a little bit, but it's led the way. Remember, it kind of led the way down. Now it's leading the way back up again. I think should we get that move lower, this is going to, the larger mega cap technology stocks will not suffer as much as small cap, mid cap growth in the technology side. So we just have to be very careful how we follow this. Okay. If we come down and look at the VIX, it moved down hard on Friday, but notice we're still up a little bit from where we were just a few days ago. So we're still kind of sitting down around this level right here, around 16, 18 at this point in time. Okay. So that's a little bit about what we're looking at here on volatility. And then of course, if we come in and we look at Treasuries, the 10-year, which has got everybody's attention. I mean, everybody's attention. Look at the 10-year, guys. The last high print was back in March, the end of March. We at 1.765 in the 10-year. And then we just slowly broke the 50 EMA, and then we've coming down. And you can see the 200 EMA, which we're testing right here. And then we gapped up. I think we may have another test of that 200 EMA. But keep in mind, I do believe before we get to the end of the year, my target was a lot higher. My target was actually around 195 to 2. So I think we're going to slowly see interest rates come back up, challenge the 50 EMA, and then possibly move above the 50 EMA. Okay. So just remember, that's kind of how we're going to do that. And the bond market fell hard on Friday. We came up, you can see just the opposite. We tested the 200 EMA and it was rejected. Okay. I would prefer shorting the bond market at this point. Remember what I've been telling you guys every weekend. I said, if we come up and test this 200 EMA, it'll be an interesting time to enter a short. I do believe we're going to finish the year, the bond market breaking the 153 level and coming down even lower over time as we go through the end of the year. All right. So that's a little bit about what I'm seeing there. And then, of course, if we come down here and we look at gold, longer term, I'm bullish gold. Short term is just chop. All right. I do believe we're going to be moving up. We're going to be chopping around here, but longer term, we're moving up. We got a trade we're running in gold right now and in silver to the upside, but it allows us to adjust and accommodate if we just stay in a chop mode for a while. Okay. And then finally with oil, oil had a strong Friday. You can see here how we're off these highs. Like this key pivot here on this Elliott wave 3, this key pivot here, and this, it was a very bearish candle way up here, then closing down towards the lower end. I'd say fade that move, run sideways to fading the move down to the 50 EMA until oil kind of sorts itself out. Okay. So these are just kind of some of the things that we're looking at now. Members, I will see you in our weekly Market Watch Sunday evening. If you're not a member, I highly encourage you to come in and join us. It's going to be a lot of fun. These next 6 months for this year, I think, are going to offer up a lot of interesting opportunities for us. All right, everybody, have a really great weekend. Members, I'll see you this Sunday evening. Ciao now.